Okay, the world of options trading can feel overwhelmingly complex. But what if one of the most effective strategies was also one of the easiest to understand? In this video, our head of options trading is going to teach you just that. Hi, I'm Mike Bellafiore, co-founder of S&P Capital. We're one of the top proprietary trading firms in the US with a history of developing numerous 7 and even 8-figure per year traders. You've found the right place to learn from the pros.
Hi, I'm Seth Freudberg, and I'm the head trader of S&P Capital's options trading desk here in Manhattan. And you may have heard that options income trades can last for weeks and even months, and that of course can be true, but the fact is that the options market has now evolved to the point where there are a number of stocks and indexes that have options that expire almost every single day of the year, which means that if you find an overnight option strategy with edge, you can trade it day after day throughout the year as a way to grow your account and produce income for yourself and your family. And today, we're going to be showing you an example of a trade which fits that exact description. And perhaps more importantly, we'll be teaching you why the trade works. And so if that sounds of interest to you, then stick around, because I think you're going to be surprised at how easy this is, as well as the very interesting reason that it can make money every day. Before we get into the option strategy we'll be teaching you in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we've put together a video for you to understand options basics. So if you click on the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategy that we're going to be sharing with you in this video. Then when you're finished, you can come back and watch the rest of this video. Okay, so to illustrate to you how this trade works, let's head back to earlier this month on June 10th. And let's take a look at a price chart of SPY, the Spider S&P 500 Exchange Traded Fund, ETF, a stock which is comprised of a basket of stocks representing the S&P 500. And let's take a look at the stock's price chart for the current year. And so after hitting its all-time high of 613 in February, tariff worries triggered a sell-off, which ended about 6 weeks later in early April, when there seemed to be light at the end of the tunnel of a full-out trade war, with the market betting that the gap between the U.S. administration's positions and the rest of the world could somehow or another result in a compromise and an ultimate resolution. And so by June 10th, the market had actually regained most of what it lost during the sell-off, closing at 603.08 that day. And so since we're going to be discussing an overnight trade, you need a little bit of time to set up the trade, execute it, and have it filled by the market. So it's a good idea to start an overnight trade within the last 30 minutes of the cash market close, which of course is 4 p.m. Eastern each day. And so if we move to 3:30 p.m. that day with the stock trading at 602.43, let's pull up an options chain that expires at the end of the next day, June 11th. And we go ahead and find a call with the strike prices closest possible to the current price, which in this case is the 602 call, and we go ahead and sell 10 of those for a price of $2.59. And then we move to an options chain that expires a week later than the 10 we just sold, which is the June 18th options chain, and we buy 10 of those for a price of $5.44. And so when we do that, selling a call option on an options chain and then moving out in time to a chain that expires later than the one we sold, and buying a call option on that later expiring options chain at the exact same strike price as the call we sold, when we do that, we are executing what options traders refer to as a call calendar spread, one of the most powerful options income strategies. When we do this, we're going to have a cash outlay. And the reason for that is that any option at the same strike price farther out in time will always cost more than an option that expires before that, because obviously the seller of that option has to charge more to guarantee that he'll sell his shares for a fixed price farther out into the future, because the more time the market has, the worse that obligation could look for the guy selling it. So he needs to charge more than one expiring closer in time when there's less time for dramatic things to happen. And so the cost of the 602 call option expiring on June 18th was $5.43, but you multiply that by 100 because each call option represents the right to buy 100 shares at the strike price. And so you multiply that by 100 and you bought 10 of them. And so when you multiply the whole thing together, you get a cost of $5,430. But then remember, you also sold 10 of the 602 calls that expired the next day for $259. And so with the same kind of math, we can see that we received $25.90 for selling that one, resulting in a net cost to us of $28.40, which is also the trade's worst case scenario. You may be wondering at this point, how can we make any money when we sell a call at the same strike price as we buy one that expires on a later options chain? How's that going to make us money? Well, let's take a look at the trade at the end of the next day when the first of the two options expires. Well, as you can see, on that day, the SPY experienced a slight sell-off, closing at 601.38. And remember, our call options were both at a 602 strike price. But think about it. With the SPY closing at 601.73, then those 602 calls, which expired that day, would be worthless, right? Because there's no value to the right to buy the shares at 602 when the SPY closed below that at 601.73. Obviously, if you want the shares, you could just go out and buy them for cheaper than 602. So that option expires worthless. But what about that call that expires a week later on June 8th? Now that is a different story. You see, that option is still alive at the end of the day on June 11th. It's got a week more to go before it expires. And furthermore, the stock is trading only 27 cents below that call strike price. Well, a lot can happen in a week. And so that right is still pretty valuable, having dropped a bit, but still trading for $4.56. I mean, if SPY rallied to, say, 620 over the next week, just a 3% rally, you'd have the right to buy the stock for 602 when it's trading at 620. And so that option is going to have a value of $18 if that were to happen. And so obviously the seller of that call has to retain a lot of price in that option because he's exposing himself to that happening and having to sell his shares for 602 when they're worth so much more conceivably. And so now it's easier to understand why that option still retained most of its value. And so with the expired 602 call worth nothing, and if we were to at that point sell the long June 18th call expiring in a week, as you can see, that's worth $45.60 to us. And when we subtract out the original cost of the calendar spread of $28.40, that means that our profit on the trade would have been $17.20, which is an overnight return of 60% against the original cost of the trade. And so the major thing to remember about call calendar spreads is that the reason they make money is that the option that you've sold, which always expires first, will always lose value faster than the option you've bought, which always by definition expires later. And so that relative loss of value between the short and long options can cause the short options to go to a very small value or even zero, as it did in this case, while the long option that we bought will always retain plenty of value because it's got to cover the risk of the stock rallying a lot before it expires. Whereas the expired option obviously has disappeared and can't have any value logically if it closes out of the money like it did in this case. Now, before we wrap up, I want to make some very important points about this trade. And the first one is that this trade will not always go this well. This was a very strong trade, and most will not be this successful. We're just showing you this example to give you a taste of how powerful the trade can be. And so if you get a really big move overnight, you're probably going to lose this trade. For example, and this is just one possible case, if the SPY had sold off substantially the day after we put this trade on, then yes, the call we sold would have gone to zero, but the call we bought would have lost tons of value. And by the end of the trade, its value would be less than our original trade cost, meaning we'd lose money on the trade. And so what professional options traders do is to undergo rigorous backtesting of a strategy that you would like to employ every day to make sure that the profits on the winning trades over time far exceed the losses on the losing trades. And to make that happen, you're normally going to have to employ a target profit that's probably going to be a lot lower than 60%, like we showed in this example, as well as a stop on the trade of some number reasonably proportionate to the target profit. So, for example, lots of people will trade a strategy like this and they set, say, a target of 10% and also a stop of 10% on the trade. So, much more modest goals, and on the other hand, a much faster exit for a loss if the trade isn't going well. Once you backtest the trade, you'll start to get a feel for what would be a realistic profit target and a realistic stop loss combination to make the trade over time profitable, or what professional traders refer to as a positive expectancy. Any new trade, and particularly overnight trades where a big overnight move could cause a substantial loss, should be traded on a very small amount of capital for a very long time so that you can experience all of the nuances of the trade in a live environment to make sure that your back tests reflect the reality of how the strategy trades. If once you've started to trade it live in the market, the strategy performs as well as your back test for an extended period of time, then you can consider very prudently, slowly increasing your capital level so that you can psychologically adjust to the large capital level and the greater risk you'll need to be able to tolerate at higher capital levels. And so what I'd like you to take away from today's video is that there are option strategies that can be traded as an overnight trade every day of the week, because a number of ETFs and index options now have daily expirations, which wasn't the case until about 3 years ago. And so if you act like a professional trader, study a trade through historical backtesting, establish sensible target profits and stops through trial and error, all of which takes some effort, of course, you can conceivably be trading that strategy daily and begin building the size of your trading capital, possibly dramatically.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.